What's going on, everybody? I'm back again with another video, and in today's video I'm gonna be breaking down liquidity, how to spot liquidity on the charts, and hopefully help you guys improve your win rate, pass your funded accounts, and hopefully maybe even get your first payout. Have you ever noticed that right before a trade's gonna hit take profit, it goes and wicks your stop loss and then moves into your favor? That is a liquidity grab. I'm gonna show you guys how to spot these key areas of interest, help you guys mark them out, so in the future, it can help you guys improve your trading. Now let's go hop on these charts and show you what I mean. Now before we actually start, marking it up and how to spot liquidity, I kind of want to give you guys a background of what even is liquidity. What is the concept behind liquidity, right? As you know, above every swing high and swing low, there's buyers and sellers, right? So for example, behind this swing high, before we sold off, there's obviously people selling here to create this move, whether it's institutions, whether it's retail traders, whatever. But as you know, there's orders up here, whether it's stop losses or other future sells. Because up here, when price comes back up into this area, that's I would say a pretty expensive price, right? So like buyers that are down here, when they come up and take out these highs, what are they going to want to be doing? Selling off their buys, right? All this up here is liquidity. When we create this wick up here and drop all the way down, that creates an area of liquidity. So when you see an area like this and price comes up and takes this out, what do you think is going to happen? You're going to see a down move, right? And you can see this not just, on these areas here, but you can also see it, on the other side. This is an area of liquidity. We haven't came down here yet, but for example, area of liquidity, we take it out and we get in a reaction, right? Liquidity, whatever, right? There is tons of areas of liquidity. Now, the point of this video is how to spot liquidity and how to know which areas of liquidity are key areas, how to know that there's going to be a reaction off that, because it can get kind of noisy when you're just seeing all these areas of wicks. Like, how do you know which area is a key area of liquidity and when to take that area as a sell or buy, right? And I try to keep it super simple because I used to be that person that would think everything is liquidity, and I would struggle a lot and get stopped out. I'm thinking, oh, that's the area of liquidity that I want to be in, so I'm gonna place a buy, and then I get stopped out again, and then it moves in my direction, right? So how do you know which liquidity is the key area that you want to look for? And again, I keep it very simple. I look for the previous day high and the previous day low of the current session I'm trading. So I usually just trade New York. So I look at the previous trading day's high and low, and I wait for reactions on those key areas. So for example, today is Wednesday, and this traded into today, right? This is Tuesday Asia session, and this is current New York session right now. So I'm going to be looking at, you see these little dotted lines here. I have them here so I can see the previous day open and close, and that's my previous day session. So I see this high here, and I see this low here, right? And what happened when we took previous day high? We sold off, right? We had an immediate reaction. Now this is Asia session, 10:30 p.m. my time, and then going into London, right? So I didn't take this, but for New York session this morning, since this is the previous high from yesterday's high, I then look for this liquidity to be taken, right? I still have this one here, which it never came down to, right? Because we're all the way down here. And I wait for a break of structure to the downside, right? Now, we made this high and then we made this low. So really what I'm looking for is to then break this high here, right? We break this high and then hopefully we break this low down here to start making that structure to the downside, right? But notice, every one of these little bars here, these swing highs and swing lows on this 15-minute time frame, there's some sort of reaction once we come up and take either this low here, we had a buy up, we take this high here. So that's kind of what I'm looking for. And what I'm looking for after we, break the previous high here, come down, we make another swing low, we come out, break this swing high right here, this new area of liquidity, we break it, then I look for a breakdown to indicate, hey, we might be starting to move down here. So then I look for an area of to retest up here, right? I didn't take anything today. It is, getting close to Christmas, and the markets, I feel like, have been really slow. So it's been about a week since I've taken any trades. But if I don't see any kind of order block to enter off of, then I'll look for some sort of 5-minute order block, right? Kind of refine what I'm looking for. And then boom, we have one right here. You guys know I like to enter off the equilibrium of the order blocks. If you don't enter off the equilibrium, then cool, you could have already entered and be in profit, right? And we're really late into the trading day, so I didn't take anything in general, but normally I wait to get into the equilibrium just to get a kind of tighter stop loss. So I don't like to risk too much, so I tend to enter off the equilibrium versus just entering off strictly off, price action and waiting for some sort of engulfment. I find the best, my results are better when I enter off the equilibrium, whether it's a loss or not. I can get a tighter stop loss and a higher risk to reward ratio. That's kind of how my thought process on liquidity, right? So again, liquidity are areas of swing highs and swing lows where there's orders above, right? Whether they're stop losses, for example, on these buy side liquidities, where market has to buy up to take out these stop losses, or for areas to sell, right? You have sell orders here, so naturally the market's going to come up and be attracted to this area for buyers to sell their orders, or in turn for buyers to take out previous sell stop losses up here. Now, I did pass another funded account last week on Top Step. See the email on the screen. Let me show you that trade I took so you guys can see how I use this in real time, or in real trading, right? So I actually took this trade here, this buy up, right? A 1 to 3, and this had me pass another account. Now, what do I see here, right? When I was trading New York session, right, which I'm in Mountain Standard Time, so 7:30 is my stock exchange open. I usually wait till after the stock exchange opens to enter any trades to avoid any kind of volume, unnecessary volume on the open. This is the trade I took, right? So New York Stock Exchange open, we took out the previous day lows, right? And I look for, again, a shift of structure to the upside if we take sell side liquidity. I don't enter trades just because we took liquidity. I used to do that about a year ago until it did not work. When they just kept taking liquidity over and over and over again, I learned, hey, let's wait till we actually break structure to the upside. Let me start from scratch here, right? So you guys can see what I'm looking at. Boom, we break this down, right? So then here is the new low. Okay, here's the swing high of this low before we make a new low, right? Boom. We come down, we make a new low. So this is the new low. So what do I look for? I wait for markets to push up past this swing here to indicate we're making structure to the upside, right? I'm like, okay, bet. Here's a little order block here. I enter off the equilibrium, right? I had a 1 to 3. I don't know exactly my placement was for my stop loss. I usually do about 5 ticks below the previous swing. Here we are, come into the equilibrium. I entered off that. As you can see, we went pretty much almost straight into TP. Yeah, and the reason why I really like trading liquidity this way, because it allows me to get my stop loss above or below the most previous swing high or low. And I would say this is pretty much a really safe stop loss, because if we break down and hit the stop loss, then we just take liquidity again. And I kind of just wait for this over and over again. Because of course there's times where you break previous day liquidity and it just keeps breaking down. And I only enter the trade if we break structure to the upside. So yeah, that's kind of how I trade liquidity. Again, you can do this both ways for sells when we break previous days highs, or buys when we break previous day lows. Now, another situation you can find yourself in, right, is what if you're stuck in the swing of both, yes, the previous day high and low, right? For example, here and here, right? This is the previous day low of this trading session, right? Now, what I do personally, as I don't really trade like this, I don't like to trade in between the previous day high and low, just because market can be attracted to either side to take that liquidity of yesterday's liquidity, right? So personally, if I was gonna trade this, I'd probably look at where is the closest liquidity, right? If markets are trending up, taking out liquidity, let's just say we're like at the equilibrium of this area, I would probably target buys to take out the most likely liquidity. But again, markets didn't go all the way up there and ended up reversing, right? But that's kind of how I would trade in the zone, in the middle of the zone. In this case, it didn't really, nothing really happened. I wouldn't have traded anything here, but like, let's just say you're up here in the markets. The markets are currently right here, trading right here. Ignore all this. Markets are currently trading right here. Where is the market more likely to go? Is the market more likely to go to this buy side liquidity, or is the market more unlikely to go to this sell side liquidity? Ask yourself that. What's more realistic, right? In this case, markets didn't go all the way up and take out this liquidity, but in most instances, right? Not all, because again, this is all probability. Trading is all probability. There is no 100% strategy or ways to trade. It's completely probability. You just got to have probability in your favor and look for high probability setups. And in my opinion, through my experience and the way I trade, trading in between these two liquidity areas, I'm more likely to lose versus waiting for previous daily high or low to get swept and then waiting for structure to break to the upside. So again, if I were to trade in the middle, I would probably be looking for buys here, taking out this liquidity. Now, if markets were doing the opposite, and let's just say trading down here, I would look for that same kind of concept, breaking structure and then looking for a retest into this area to then take out this liquidity if market hasn't taken previous day highs or lows. But yeah, everybody, that's pretty much how I trade liquidity. Hope I broke this down good enough for you guys. I'm trying to get better at explaining these concepts, so yeah, let me know if you guys have any questions in the comments or anything that's confusing you. Maybe I can make a future video on it. But this is how I view liquidity and how I trade liquidity. So if you found this helpful, please like, subscribe, and stay tuned for next week's video. Thank you guys so much for watching.